Anyway, I think we can start and while we're getting the slides up. So thank you very much, everyone, for joining us today at the virtual roundtable on the AASB invitation to comment 45, that is on the Ipsasby measurement-related proposals exposed in exposure drafts 76 and 77. By the way, introduction, my name is Friedrich Horsa, and I'm a member of the AASB staff as a Deputy Technical Director, and I'm joined today by Patricia Au, Assistant Senior Manager and Project Lead on this project, and Jim Paul, long-standing AASB staff member who is consulting on this project with AASB. If we can move to the next slide, Patricia. This is the agenda for today. The focus is to provide and discuss an overview of the Ipsasby proposals contained in those two exposure drafts that I mentioned, on which AASB is planning to make a submission. Your input will be valuable. Your feedback will be valuable input into board, AASB board discussions when forming its view how to respond to those proposals. And obviously, we will welcome any submissions on the back of this session. The AASB issued the invitation to comment, focusing on a couple of the particular aspects of those of the Ipsasby proposals, and one of the key one is the current operational value measurement basis as an alternative measurement basis to the fair value for the operational asset, which is the term ITC 45 is using, and that term is essentially meaning to represent non-financial assets that are held primarily for service capacity or service potential, rather than the ability to produce net cash inflows. And Jim will touch on that term later on. The focus is on whether the current operational value or fair value is appropriate measurement basis for this type of the asset. So it's about how to measure current value of the operational assets, not to when to measure those assets at current value. So this part of this session, staff will provide overview of the key aspects of the current operational value, and also on the application of cost approach to this and a fair value measurement basis. As we are going through the topics, we'll be posing a number of the polling questions. We'll be seeking feedback from the roundtable participants, as well as there will be a Q&A session that will provide opportunity for participants to express their views and ask questions, but also AASB staff will be soliciting feedback from the participants why they selected particular option when answering to the question. To do that, you should be able to access raise hand button within the reactions button at the top rightish part of your screen. Please do let us know if you cannot locate that button, and then the current host will give you the floor when they will get to you. More importantly, the session is recorded, as you probably saw announcement on your screens, and will be made available on AASB's website. And I hope this is okay with you, but do let us know if you have any concerns. Other housekeeping matters, our usual disclaimers. Any views presented or expressed in these presentations are the views of the presenters and are not necessarily views of the board or other staff members. I think with that, we can move on to the next slide, which is we are seeking to gather some information. Who do we talk to, and we would like to understand the composition of the attendance group today. So with that, we would like to ask you, what is the stakeholder group that best describes you? And thanks, Patricia, for opening the poll. So please select an option. So I see we have 76 participants voted, 82%. I think that's it. Patricia, considering if it's taking into account AASB staff as attendees too.
Sure.
Thank you. So, and can you share the results? So hopefully everyone can see the results of this poll, and it's good to see that we have a reasonably good balance of the stakeholders group represented on this at this roundtable. Unfortunately, I don't see any users of the financial statements, and that's in line with our experience that we do need to make as AASB conscious and additional effort to get views from the users. So no surprises there. I should probably also say that yeah, the feedback from this session will form valuable input into the further AASB board deliberation on this topic, if I haven't mentioned this before. So with all of that, unless I forgot anything, and Patricia, Jim, remind me if I did, I will hand over to Jim to take us through the slides and lead the Q&A session that is associated with that. Thank you. Jim, over to you.
Thanks, Freddie. Hello, everyone. The Ipsasby's proposals in relation to measurement are much broader than current operational value and measuring current value of operational assets. So to give a sense of what we're focusing on in relation to the broader scheme of things, I note that the Ipsasby proposes 4 measurement bases. One of them is historical cost and 3 current value measurements. One is current operational value, then cost of fulfillment, which is specific to liabilities, and also fair value. In respect of measuring the current value of assets, the Ipsasby proposes that fair value be adopted for assets that are held for their financial capacity, and that current operational value is used to measure operational assets that are held for their operational capacity. So as Freddie mentioned, today's focus will be on current operational value, which is just highlighted there. So turning then to the next slide, please. Ipsasby is proposing that fair value is inappropriate for assets held primarily for their operational capacity, and instead proposes current operational value measurement basis. However, presently, Australian public sector entities measure the current value of all assets, including those primarily held for their operational capacity, at fair value under AASB 13. The AASB is undertaking a project currently on fair value measurement for not-for-profit entities, originating from public sector responses and requests for guidance on applying AASB 13 in the not-for-profit public sector, with particular emphasis on operational assets. Ipsasby's ED 77 proposes application guidance on some measurement issues that AASB has also been deliberating in the context of a different model, that is the fair value model. Therefore, AASB decided to monitor the Ipsasby's measurement project and in turn review its previous decision that fair value in AASB 13 can represent the service potential currently embodied in operational assets. The AASB issued invitation to comment ITC 45 to invite comments on the Ipsasby's proposals. It included specific matters for comment to elicit views on current operational value as a proposed alternative measurement basis to fair value for operational assets. And the AASB hasn't prejudged that at all, and nor are we implying as staff that the AASB might or might not move from a fair value approach, but just to say that it is considering all options. Therefore, amongst all of the proposals of the Ipsasby in relation to measurement, the focus today is on current operational value, because that ties into the project that the AASB currently has underway, and will of course be highly relevant to stage 2 of the AASB's not-for-profit conceptual framework project, where it will consider the revised conceptual framework it issued for for-profit entities and what modifications might be appropriate for not-for-profit entities. Next slide, please. The subject for discussion today is assets held primarily for their operational capacity, which are referred to as operational assets, both in Invitation to Comment 45 and in today's discussion for ease of reference, even though it's not actually a defined term as such. Some people may refer to this type of assets as assets primarily held for their service potential. The Ipsasby conceptual framework defines operational capacity as the capacity of the entity to support the provision of services in future periods through physical and other resources. Assets held primarily for their operational capacity are essentially the same as the term in AASB 136, impairment of assets. That is, assets are not held primarily for their ability to generate net cash inflows, which that standard says are typically specialised assets held for the continuing use of their service capacity. AASB 136 states that it does not apply to such assets if they are regularly revalued to fair value. Therefore, the distinction made by the Ipsasby about current value measurement requirements of what we call operational assets parallels a measurement distinction made in Australian accounting standards. And specifically, we are discussing operational assets that are measured at current value. In the context of Australian accounting standards, this includes both measurements that are made under the revaluation model in AASB 116 property, plant and equipment, and also where the cost of donated assets is measured using a current value. That is, we are not discussing application of the historical cost basis to operational assets. There are no significant unresolved practice issues facing Australian public sector entities in relation to that cost model in AASB 116. Next slide, please. Turning to the fundamental issue of choosing between fair value and current operational value for measuring the current value of operational assets, let's look first at the respective definitions of those measurement basics. And you can see that those definitions on the screen. The last definition on the slide is an alternative definition of current operational value included in the alternative view of two Ipsasby members. We will discuss that alternative definition in a later slide. Next slide, please. In relation to measurement techniques, the same measurement techniques can be applied to estimate current value and current operational value and fair value. And both of those approaches involve maximising use of observable inputs and minimising use of unobservable inputs. The question, though, of what sort of inputs or who is the source of the inputs is where the difference may lie because of the difference in focus between market participant data. So the three approaches are the market approach, cost approach, and income approach, and you'd be well familiar with those in the context of AASB 13. So the Ipsasby is also proposing that they be used, but their application can sometimes differ between the two measurement bases of fair value and current operational value. Next slide, please. An important part of current operational value is the measurement perspective it adopts. Firstly, as I alluded to a moment ago, it doesn't use the market participant focus, it uses an entity-specific focus. Secondly, under fair value, an asset's highest and best use would be used as opposed to just assuming its current use, which is what's proposed under Ipsasby ED 77. That is that it would disregard potential alternative uses and any other characteristics of the asset that could maximise its market value. In developing the definition of fair value in IFRS 13, which of course is adopted in AASB 13, the IASB specified that the asset must be measured on the basis of its highest and best use because that use underpins pricing decisions that market participants would make about an asset. And this ties into the requirement in both those standards, IFRS and AASB 13, that the assumption is that market participants would act in their economic best interest. The IASB also noted that highest and best use is a valuation concept widely used to measure many non-financial assets, for example, real estate. The Ipsasby proposes that an asset's current operational value is measured on the assumption the asset will continue to be used for its existing use, disregarding potential alternative uses. This is because the Ipsasby considers that meeting a service delivery objective often does not satisfy the asset's highest and best use. Ipsasby ED 77 does not elaborate on this, so it is unclear whether the intention is to employ the notion of market value for the existing use, a notion that's been in valuation literature from a long way back, but has tended to fall into disuse over more recent times. Ipsasby's proposal to assume only the asset's current use applies even for unrestricted assets. So it is not simply a case of reflecting that restrictions might preclude alternative uses to the asset's existing use. On the contrary, as we will see later, the Ipsasby proposes not to reduce the current market buying price of equivalent assets for the effect of any legal restrictions on the use of an asset. The Ipsasby seems to indicate that assuming an asset's highest and best use might overstate the value of the asset to the entity in carrying out its service delivery activities. However, there are no illustrative examples to clarify what is intended. So just returning to fair value, AASB 13 defines that as an exit value, consistent with the ISB's focus on reflecting market participant expectations about the net cash inflows to the holder of the asset, either through use or sale. The ISB emphasised its conclusion that a current entry price and a current exit price will be equal when they relate to the same asset on the same date in the same form in the same market, which must confess is a somewhat limiting assumption, but that was its starting point. AASB staff note that if the market participant buyer for the asset were to be another not-for-profit public sector entity needing the asset to render the same services, there's no apparent reason why the amount for which the asset could be sold would need to differ from the amount of its current entry price. Turning then to the next slide, we now turn to our questions about key aspects of current operational value, starting with whether to assume an operational asset is used only for its current use. So continuing from the earlier slide, noting that proposal of existing use, let's test your thinking with an example. Example is unrestricted vacant land with harbour views being used as a storage site with the potential to be redeveloped for residential dwellings. So there'll be a polling question. This is question 2. And the question is, should the current operational value of the unrestricted vacant land be measured as A, the market price of land that could only be used for storage, or B, the market price of land capable of residential development? We'll welcome hands up for comments afterwards on your reasons for your selection. So I'll give a moment now for you to make your selection.
Jim, I think it might be worth emphasizing that in this example, the land it's not restricted. There will be later on today, we will be talking about restricted assets. But for this example, the land it's not restricted, just that the entity has chosen to use that land as a storage site.
That's important. Thanks very much, Patricia.
Okay, so I think we are still waiting for a few attendees to respond, if they wish so.
Maybe we can end the poll and start discussing. So more people for land, for valuing the land, considering the capability of residential redevelopment. We want to check whether any participants would like to share their views on this question. I don't see any hands up. Adam?
Hi guys. Yeah, so I suppose in my answer, I did answer that the market price would be capable of residential development, and that is based purely on the definition as proposed of what current operational value is as proposed. Under a fair value basis as well, we'd be looking at the highest and best use anyway, and the highest and best use, my assumption is that this is zoned for redevelopment potential. So that's, I suppose that's the basis of my response, being under the current operational value as proposed definition.
Thank you, that's very helpful. Chen?
Thank you. I just think that this question needs to be answered together with more understanding of what the actual policy is and why they decide to use for storage. It's similar to, I think, the accounting standard for investment property. It's not just what you use it for, but also what is your strategy is for that property. So I might be renting it now, but I have a clear strategy that later on I need to use it for parking for the community, for example, and I can still measure it as not as investment property. So I think really the policy stand and the strategic decision for that property is also needs to be considered when you consider how to measure it. Thank you.
Thanks. So if I may, to summarize, that would be the view that prioritizes current use and entity specific component of the valuation aspect, as opposed to the other view that was more looking at how the market participants would be looking at that unrestricted piece of land. And I'm hoping that I'm summarizing Chen's and Adam's view correctly.
Yes, thank you.
Thank you very much.
Okay, if we have no other hands, I might move then to the next slide, which is the definition of current operational value, slide 13. Exposure drafts ED 76 and ED 77 propose defining an asset's current operational value as the value of an asset used to achieve the entity's service delivery objectives at the measurement date. ED 76 states that current operational value focuses on service potential of operational assets, and ED 77 indicates current operational value is a current entry value. However, the Ipsasby's proposed definition does not refer explicitly to service potential or entry value. This definition was criticised by two Ipsasby members who expressed an alternative view, proposing the definition in the right-hand column of this slide. The alternative definition refers explicitly to service potential, which the Ipsasby conceptual framework defines as the capacity to provide services that contribute to achieving the entity's objectives. Now, the two reasons that were given for the alternative view, as noted on the slide, are firstly that the proposed definition does not clearly state how it would reflect the service potential of an operational asset, and also an operational asset service potential is best represented by the cost the entity is currently required to incur in the marketplace to replace the asset. And that information being useful for decision making and accountability when assets are held for their operational capacity. In thinking about this difference of views, which is the subject of the next question to participants, it is noteworthy that when the AASB issued AASB 13 in 2011, it thought public sector entities would apply the cost approach in measuring the fair value of operational assets. And the cost approach involves using current replacement cost of the asset's service capacity. And in this regard, staff see little difference between service capacity and service potential. So if we could turn to the next slide, please. So the polling question is whether you agree with the definition of current operational value that's proposed by the Ipsasby, and that's option A, and that's set out on the screen, or the alternative definition proposed in the alternative view, which is the cost to replace the service potential embodied in an asset at the measurement date. And the third option is provided is whether you propose another definition. And of course, we would be keen to know what that definition is and why, once through a show of hands, once we've completed the polling for this question. Thanks very much.
Okay, I think we have 55% of participants voted, 61. Please, if you'd like to share your view, do so. Otherwise, I think, Patricia, we can close the poll.
So more people voted for the alternative definition, but 3 people have an alternative definition to suggest.
Yeah, so keen to hear from those that are proposing. Let's maybe start those that are proposing another definition, whether they could share with the rest of the audience and us what their thoughts are. Adam?
Yes, hi. I'm coming from the point of view, I suppose, still looking at the definitions of cost approach under fair value definitions, in that the cost approach still needs to allow for obsolescence and I suppose any matters that are affecting the land or asset at the date of measurement. So those it seems like when applying the cost approach in this COV definition, it's excluding any sort of obsolescence, depreciation, any sort of I suppose any of those material matters that that are defined in the definition of the cost approach under fair value measurement.
And would you so thinking about land as opposed to any depreciable assets,
yes,
to extend that thinking, do you think also about some kind of specialization of those assets under that cost approach? Is that what you have on mind, or something else?
Yeah. So I mean, we're looking at the legal details as well, the zoning that's affecting land at the date of measurement. So there's those factors, and also, even just, things like site conditions, what is being used on the site, what the, I suppose those specific topography factors, contamination, all those sorts of things are being thrown by the wayside. It's just, what would it cost to be, what's the highest price of the cost to get into land in that particular area, and disregarding anything particular to that land.
So going back to, obviously you would like them to move that current operational value towards more fair value aspect in some way.
I suppose there's a well, we're coming from having been quite heavy in the fair value measurement for the last few years, and working off the definition of exit price, and I suppose it might muddy the waters of the financial statements, is how I see it, that if some assets are viewed as an entry price and some are viewed as an exit price, being able to differentiate those. And also we've got quite a few examples where by reporting an entry price into the market would really grossly overstate the value of that land, basically, when you're looking at the condition of the land. And also we do a lot of work for local and state government, and we routinely have questions from the finance departments there, where they say, oh, valuers last time put like a huge price on this, and we just don't agree. We don't understand why they'd be so high on this value when it's not. We wouldn't be able to do anything with it. So I think it might cause a little bit of confusion in that instance.
Mm-hmm. Thank you, and I think that's what we'll get to in a few minutes. I think, which I think is the view how the stakeholders, valuers, and other constituents are looking at application of concepts of I think highest best use and hypothetical market participant notion within the fair value, and then within the fair value in particular cost approach, because I think the cost approach, as Jim mentioned, does offer to think about entry equals exit in at least in some circumstances. But then when combined with the hypothetical market participant and highest and best use in public sector, which is specialized asset and in restricted assets area, I think that's where we do see the diverging opinions. So thanks, Adam. Keen to hear from the rest of the audience.
Martin would like to share his views.
Hello to the forum, Martin Burns, valuer. Just having a quick input here if I can. Current operational value, and this may sound a bit like a Seinfeld question, but is this a thing? In other words, is current operational value currently in play, or are we asking or being asked to ratify its existence? Because out of the three options, if there was a fourth one that said, do you believe there should be a current operational value, that's one I would have chosen. I would have said no. But so that's the question, actually.
Yeah, no, so this is just a proposal that Ipsasby has, I guess, it's developing, and so it's currently not effective. But it's an Ipsasby proposal, and the reason why the AASB would like views about COV, because it sounds, from a literal look at it, it kind of solves some of the problems that we've been hearing about fair value, because we've heard, as mentioned earlier, that the highest and best use concepts or identifying the market participants, it's not as easy with some of the public sector assets. And therefore, Ipsasby has now come up with a draft it's a proposal that current operation value being an entity-specific value based on existing use rather than highest and best use. And we're just wondering whether that might be, I guess, an easier way to measure the current value of operational assets.
Sure.
Martin, and thanks, Patricia. And Martin, as to add on to that, I do think that later in the pack, we do have indeed question whether you participants on this roundtable do prefer fair value, current operational value, or something else, which I think is the question you're asking.
Yeah, no, fair enough. Thank you.
Thank you. So if you don't have any further comments or questions from the participants, I think, Jim, maybe we can move on to the next question or slide.
Thanks,
you have
Greg.
something to add?
Yes, and I fully acknowledge there are some overlaps in a sense between some of the questions we'll be asking today, because obviously the question of definition is affected by whether you would actually support the idea at all. So I fully acknowledge that. The next issue is, should the income approach be permitted to measure assets not held primarily to generate net cash inflows? And the income approach is a measurement technique that converts future amounts, such as cash flows or revenue and expenses, to a single current discounted amount. When deciding not-for-profit amendments to AASB 136 on impairment of assets, the AASB concluded that if the recoverable amount of an operational asset were measured on the basis of the asset's expected net cash inflows, the asset service potential might be understated. However, Ipsasby ED 77 proposes that in limited circumstances, the income approach might be used to measure an asset's current operational value. And it proposes that in two very different ways as well, which I'll explain in just a moment. So the circumstances that the Ipsasby identifies, firstly, that the present value technique as an application of the income approach is used to support the market or cost approach to discount future outflows to a current amount. And the second one is that information is unavailable to apply the market or cost approach. So in relation to an example of the first scenario, the Ipsasby refers to the current operational value of a school being estimated by discounting construction costs arising during a future construction period to their present value. And it says you use this approach in circumstances like this when the timing of an outflow differs from the measurement date. And this is not involving discounting future net cash inflows or net income amounts to their present value as occurs under the income approach to fair value under AASB 13. So the focus here is on the fact of discounting future amounts rather than discounting future inflows. The second Ipsasby bullet point that's on the screen there, the examples of this are where there are some heritage items or natural resources, the cases where there might be a lack of cost or market information. And in that case, Ipsasby ED 77 says that the present value of future inflows might be considered the best estimate of the asset's current operational value. So here we are talking about discounting future inflows. So two different types of scenarios that the Ipsasby is considering. The alternative view, which is expressed by two Ipsasby members, is that the income approach should not be allowed under any circumstances to measure current operational value, because operational assets are held and used primarily for their service potential rather than to generate net cash inflows. Also, they observed that valuation based on the income approach might result in an amount that does not reflect the remaining service potential embodied in the asset. Next slide, please. So turning now to the polling question on the use of the income approach, do you agree with either A, the Ipsasby's proposal that the income approach might sometimes be appropriate to apply in measuring current operational value, or B, the alternative view expressed by two Ipsasby members that the income approach should not be permitted under any circumstances if you are in a current operational value model or basis, I should say. So I'll give a moment now for participants to express their views.
Most people have voted, so I'm going to end the poll. So more people think that the income approach should sometimes be appropriate, Jim.
So maybe if I can ask then follow-up questions for those people or participants that answered that they agree with the income approach being sometimes appropriate. Is it because of the reasons that Ipsasby outlined, or is it for other reasons? And regardless, would they tend not to agree with, I think, that the AASB view that Jim mentioned, that AASB expressed in the past, that the recoverable amount might be then understated if income approach is applied to the assets held primarily for their service potential or capacity? So anyone who'd like to share their thoughts on this, that would be great. Adam, thank you.
Hi, yeah. I suppose it seems like a fair, from our base of experience, it seems like this is something that would be a fairly limited use case to be applying the income approach, but I don't think it should be ruled out completely. Again, coming back to fair value definitions and that sort of thing, it's the fact that all three approaches should be able to be tested, and they may have relevance in a few small cases where an income approach might actually still be the appropriate thing. But just to completely throw it out would, I think, just being a bit too limiting to arrive at a reasonable value that might be relevant to an entity if we're talking about entity specifics. Yeah.
Now, thanks, Adam. If we can explore that further, and I appreciate that the question was posed, I think, within the remit of cost operational value, but happy to have the debate straddling both COV and fair value. Do you think then, when all three approaches are allowed, do you think in the area of say public sector or not-for-profit entities assets, so the assets held for service potential, the outcome under income and cost approach in terms of its value can be significantly different, which would not necessarily be the case looking when looking at the fair value or current value of the assets held for their financial capacity to generate net cash inflows?
Yeah, look, they can be varied, but I suppose us as valuers, it's our job to test the highest and best use of that asset, and it is on particularly government books. It is the minority that an income approach may be appropriate, because there are only a handful of assets where they do generally generate a market-based income. But that's not to say that they don't exist, and that they while in the minority, they are a recurrent thing where an income approach may be needed to be adopted for particular assets. It's definitely still has to be evidence-based. There's got to be the inputs there, the observable inputs that you can use to apply or test the inputs. So there's got to be observable market evidence there available to test that, but that is there in that minority of cases where we do use it.
Mm-hmm. And thanks, Adam. And do you think that those assets will be still characterized as held for primarily for service capacity or service potential, as opposed to generate income?
Yeah.
So,
there's a little bit of overlap up there, I suppose. In some instances, really, sometimes they should be in the investment properties category, like I said, there's a minority of cases where it genuinely makes sense to look at the income that's available to the site.
Okay, thank you very much, Adam.
Martin.
Anyone? Mm-hmm.
Yeah, hi. I think Adam's spot on in a lot of regards. And I think in regards to at least the question of valuation and coming up with different outcomes for different approaches, i.e. sales comparison, or what's called the market approach, the income and the cost approach, fundamentally the underlying principle of valuation that is with all available evidence, all approaches should actually come up with the same answer. It's choosing, as Adam's pointed out, it's choosing the one that's most appropriate for the type of asset you're valuing. What we find with a lot of our public sector clients is that they will just put a blanket statement across most of their asset base saying that they're all held as non-cash generating assets, even if they are typically what we might conceive as commercial assets like offices or warehouses, or something else that has potential to produce income. And I think in those situations where an asset has potential to produce income, whether it is or the intention is that it's not to, should still be valued using an income approach, because there would be or should be market evidence to support that.
Okay, thanks, Max. So is it the case where those assets are not necessarily restricted in any legal way? It's however they are used as an offices without necessarily being, say, market rent charged. However, you could clearly those assets could be realized on the market if the opportunity would arise without any delays without any rezoning, anything like that.
Yeah, I mean the fact that you take all the actual restrictions into play, and if they're in place, then they have to be reflected in what you derive as a fair value in the situation of financial reporting. So yeah, those factors come into play. Definitely.
Okay, coming back to the cost operational, current operational value, apologies. I think that's where the aim of the Ipsasby proposals is to reflect the full cost of the service potential or service capacity, being the value of the services. I think Jim mentioned that the definition of that value of the services provided, which I think then the alternative view was looking at it as the income approach, and being in extreme cases no income generated by those valuable assets could understate the service potential.
Adam.
Yeah, I just had one particular use case when we're with the definition of outflows. One of the few use cases I can see in measuring outflows might be something like a landfill, where there is, a significant expenditure required on the site. But again, it really depends on the quality of data, and often it's not that readily available in these sorts of assets. But that might be one of the edge cases where income outflows might be able to be tested. Sorry, not income. Yeah, outflows.
Okay, thank you. Anyone else would like to share the views on this poll, one way or another? Okay, I think Jim, Patricia, we can move on to the next slide and question.
Thanks, Freddie. We've dealt with all the controversial stuff so far, so now we'll move to the uncontroversial issue of restricted operational assets. If I can be serious, the example I'd like you to turn your mind to is where the current value of a public school is to be measured, and both the land and the buildings are legally restricted for use as a public school. So if a legally restricted asset can be replaced by an equivalent restricted asset obtainable in the marketplace for a price supported by observable market evidence, it seems well accepted in practice that the asset's fair value should be based on the current price of the equivalent restricted asset using the market approach. Therefore, what we're going to focus on in particular today is the views around the appropriate treatment if the equivalent restricted asset is not available in the marketplace. And of course, that will often be the case, that it's not available. Next slide, please. Of course, I'm bandying around the term equivalent restricted asset. So what does it mean? Well, firstly, it's an asset that's subject to the same restrictions on use or pricing as the asset that's being measured. And secondly, it's capable of providing the same services as the services that the asset being measured provides in its existing use. So in this regard, let's consider if the equivalent restricted asset is not obtainable in the marketplace, should the price of the equivalent unrestricted asset, for example, land that adjoins the school and is zoned for residential or commercial use, be reduced to measure the current value of the restricted asset? So if you can turn to the next slide, please. So the view of both the AASB and Ipsasby is that if an equivalent restricted asset is not obtainable, then apply the cost approach, and market participants would be required to purchase an equivalent unrestricted asset to replace the asset's service potential. So focus very much on service potential. And therefore, neither the current operational value nor fair value should be reduced compared with the price of an equivalent unrestricted asset. And that's because the market participant buyer would be another not-for-profit entity needing to pay the higher price of the unrestricted asset to obtain the service potential to provide the required services. Now, various stakeholders have argued that mandating the cost approach for a restricted asset, particularly restricted land, would depart from IFRS 13, and that the exit price of restricted land would be reduced in reality by the restriction. Today, we seek your comments on whether, under fair value or current operational value, the current value of such a restricted asset should be reduced compared with the market value of an equivalent unrestricted asset. The identification of the characteristics of the market participant buyer seems to be a crucial step in the resolution of this issue. Specifically, should the market participant buyer for an operational asset in a hypothetical sale of the asset be another not-for-profit entity needing the asset to provide the same services in accordance with its mission? In relation to the view of both the AASB and Ipsasby, operational assets are held primarily for their service potential. Therefore, normally, the not-for-profit entity would need to replace the asset at the most economical price available. In contrast, for assets that are held primarily for their cash-generating ability, a not-for-profit entity market participant buyer would, just like with a for-profit entity, be unwilling to pay more for the asset than the amount for which it could expect to generate a commercial return. You turn to the next slide then. So if you could consider in relation to specifically an example of restricted land, consider a public sector entity that acquires land in the open market, which then becomes legally restricted together with the buildings or other improvements on that land, and an observable market price for such restricted land does not exist. And before polling your views on this issue, in relation to the three options that are put up on the screen, I wanted to give a bit of background to option C. Regarding fair value measurement, so we're not talking about current operational value yet, but it's specifically in the context of fair value, we have heard the view that restrictions affect the market value of land, but the buildings like school buildings should be measured at current replacement cost, that is the cost approach to fair value, which arguably is unaffected by restrictions. That is, some argue that land is not a specialised asset and therefore its fair value should be measured using, or at least be consistent with, the application of the market approach. Those stakeholders also argue that buildings like school buildings are specialised, and therefore the cost approach is appropriate to measure them. And that's why there is the possibility, the view that's set out in C in the polling question, is a different answer for land as to the improvements on the land. So in question 5A, we'll just in context before we actually poll on that question, we'll ask you your views regarding the treatment of restrictions on operational assets in relation to applying fair value. Then in question 5B on the following slide, we'll ask for your views in relation to applying current operational value. So then turning to the polling question, question 5A, the options are that if an equivalent restricted asset is not obtainable in the marketplace, do you think the asset's fair value should be reduced for the effect of the restriction? So answer A is yes for all types of restricted operational assets. Answer B would be no for all types of restricted operational assets. And option C is yes for the land, but no for the improvements on the land. So I'll bring that up now. Thanks.
Okay, I think we have 64% of participants have voted. 10 more seconds for those who would like to express their preferences or views. Okay, Patricia, you want to close the poll?
We're split between A and C, looks like.
Thank you. Not surprisingly, if I can maybe again kick off discussion, I'm keen to hear again to start with the letter with the option C. Those that responded that yeah, the fair value should be reduced for the restrictions for the land, but not for the improvements on the land. Keen to hear, and I think that's the one of the key matters that we are trying to grapple with in fair value measurement project is to what is the distinction between the two asset classes that warrant different approach. Is it the nature, the marketability, the type of the restrictions, the type of the use? Keen to hear what drives that distinction in the approach. Please, who is willing to share the thinking behind the option C? To start with, it would be great. Thank you, Adam.
Hi, yeah, so I voted C, and that's based on the general approach that we take currently. That is that land, while there is not specific direct equivalent land available, there is market evidence available for land that needs to be used. Whether you're delineating and saying it's a cost approach I'm using for the land or a market approach, you're still using market evidence within that cost approach to some extent. So at the date of measurement, if a restriction has been put in place, our view is that there's a legal zoning restriction that a market purchaser at that particular date needs to account for when they are buying that land, because there will be a time and money cost in getting it converted back to an unrestricted bit of land. So when on the flip side, when we're talking about the improvements, there's no specific market evidence for the education buildings that are on that land. Therefore, we have to defer to the cost approach. So we're just looking at the cost approach, the replacement cost, and allowing for depreciation, all that kind of thing. But yeah, so when you are looking at land values, you are still analysing market evidence, but you have to account for those specific restrictions that are in place at the date of measurement.
Thanks, Adam. And does that mean that implicitly or explicitly you are bifurcating the buildings or improvements on the land from the land, even though obviously they are inherently related, if not dependent. Because obviously, if it's a school or public hospital, it's restricted, at least in a way, because it's on the restricted land. If it's not restricted itself by its current use of the owner.
Yeah, I mean, there is a definite separation, and that is because the market evidence is there for one class and not for the other. I suppose we do have examples in Queensland for where there was state government disposal of surplus school sites, and even in those instances they were not selling at the same rates as surrounding land values. Even in that instance, where we typically in some instances would see if it's surplus land, then going at market rate would be the appropriate approach. So I suppose it does depend on market, the publicly available market knowledge. If there is no evidence that the school in use is going to be disposed in any way, we have to assume that the school is going to exist for not indefinitely, but for at least an extended period. Yeah, there is that separation between the two classes.
Okay, thanks. And this is what I do try to understand is that when I'm looking at that school on that on that land or that measurement date, does that approach then assumes that, okay, I may have a willing market participant, not necessarily not-for-profit entity, but who would be willing to buy that or acquire that building at full replacement cost, regardless that it's used as a school and it's actually on the land that is restricted for the use. And on the same land, on the same day, I'm actually applying that restriction. So I'm assuming that land is restricted and going to be restricted for its use. And I think that's where, from the standard setting perspective, to come up with some principle that would apply in both instances, I think that's the challenge we are trying to solve. Again, when we are talking on the fair value side, what is the distinction between the two?
Yeah. I suppose if you're talking about a specific government buyer, you're probably talking more about a special value to that buyer in those instances rather than a broader market, I guess. It is, yeah, there's definitely, I mean, there's always room for interpretation and subjectivity in some of these matters, but it's, I mean, as valuers, we are required to investigate and look at land in comparison to other land, and we do have to defer to legal and physical restrictions on that land at dates of valuation or measurement. Yeah, it's but it is, I definitely can see it does cause quite a lot of debate, as we've seen of recent years. Yep.
Yeah, and that's true and correct, and thank you. What do you think about, and again, I'm very thankful, Adam, that you are keen to share your views and willing to share your views. What do you think about that notion that I think the alternative view or proponents of the AASB tentative view to date would be that we could define hypothetical market participant as another not-for-profit entity who, to deliver the services within their mandate, would be willing to buy off that school, which would support the full, if you want, current replacement cost valuation for the building. But then, if we would be in agreement for this part of the discussion, then what would be in your mind, what would prevent to apply the same notion to the land, that we would we could assume that there is a hypothetical not-for-profit entity that would be willing to purchase that land to deliver the services, and therefore they would be okay with the restrictions. It would not impact the value of that land to them in terms of the service potential, and therefore they would be buying willing to pay the current replacement cost of that land.
I suppose that is talking in like quite specific hypothetical use case scenarios as well, in that I mean, you'd expect that an independent third party at an arm's length transaction would try to minimize the amount that they would pay to get into a particular site. So I'd like to think that they were, back to valuation principles, we talk about willing buyer, willing seller, and both are knowledgeable. They would be not wishing to pay more than a typical buyer would in an open market situation. So it's, I mean, you could nail down these specific definitions and use cases, but when you get down to too much critical definition, you might be doing it at the expense of the majority of use cases for one particular use case. So it's, it's the definition is then just getting applied more broadly when it's really restricted to one specific particular bit of land. So it seems like it gets into it's drilling down into too much specifics on definitions. Yeah.
No, I agree. We are using a specific example. At the same time, it's I personally don't mind to test principles on maybe on the extreme side of the scenarios or spectrums, just to see whether they hold, at least to some extent, in those circumstances. And I think saying at the principle level, and I agree with the willing buyer and willing seller. When I'm looking into that, I would be then also expecting willing seller not to be to appreciate that there is another not-for-profit entity that would be willing to buy that land of restrictions to deliver the mandate, and therefore would they have the reason to accept price lower than would be the full cost of replacement, current replacement cost, if they would know that the willing buyer is looking for the land with the existing restrictions. And I think that's where ultimately at the principal level, in my mind, it could level up to the current replacement cost, even under the fair value approach, not necessarily under current operational value. But I take your point that I think it goes down to the distinction between the land and the building, and a slightly different perspective on the two, I think. Okay, anyone else would like to share their views on either option A or B, why they selected to reflect restrictions on all types of the restricted assets or not at all, which I suppose is probably in those participants that don't necessarily subscribe to fair value. Marius. Thank you.
Good afternoon. I'm an auditor of local government entities in WA. So that's my particular perspective. Really appreciate Adam's comments and the debate. The reason I chose C is because of the availability of audit evidence under C, as opposed to the availability of audit evidence under A or B. So for an auditor to find, or for an auditor to agree with a client's hypothetical not-for-profit that will buy for the same exercise of the same mandate is much more difficult and much more hard to support than it would be if land would be valued on a land value basis, but restricted for the restrictions of applicable to the land. So that's my angle to this. Is that I appreciate the different views, but certainly. There's more observable evidence under option C for me, whereas the replacement cost of buildings, specialized or otherwise, is a concept that's been really done really well across the industries, especially that I audit. So I don't have as much evidence, need for evidence on the construction and the replacement cost of buildings as I have for land, where there's restrictions on land, and the hypothetical not-for-profit is not always close by.
Thank you, Marius, and that's a very good point. That there are different implications on the cost to preparers and, of course, to the auditors to deliver the information. I think at some point in this session we'll have also a question on the implications for assurability and auditing. So thank you for that perspective, and thanks for sharing. Okay, I think Jim and Patricia, we can move on to the next question, which is it the same question under the cost current operational value?
Just in relation now to current operational value rather than fair value, and recognising that some of today's participants are more interested in fair value than current operational value, but for the sake of completeness, definitely like to hear your views on this one.
And I think here it's important to stress that this is for current operational value being more of entry concept. Yes, I think we have 52% of participants that have voted yet already. I'll give it another 10 seconds for those. I'd like to, okay, maybe we can close the poll. So I think, if I recall correctly, and Patricia, correct me if I'm wrong, this is not that too different to the fair value or the results of the same question under the fair value, even though I think maybe seeing slightly shift into the no restrictions for the operational assets. But I think it reflects generally the view on current operational value is maybe not necessarily the preferred step once we already have a fair value and cost approach within the fair value. I think it's not the first time we are hearing this, if I am implying those or translating those results correctly.
Yes, but do we want to hear from or see what the participants want to share, particularly for those that have voted for B, that they don't believe under COV that that restrictions should have any impact on COV?
Yes, I agree. It would be good to hear from someone who does look a bit more favorably maybe on the current operational value, and therefore and also doesn't think it should be impacted by restrictions, which I would probably call a full entry or replacement cost. So far, we have probably heard views more in the camp of the fair value approach. Anyone like to share their views? Let's put a hand up. And again, maybe try to spur the debate further. Is it because you do believe that the restrictions don't have an impact on the value of the service potential delivered those by those assets, and is it that you do subscribe to the existence of hypothetical not-for-profit entity market participant. Okay, maybe we can move on to and we may get the debate come back when we are talking about the current operational value versus fair value.
Okay, so next slide, please.
There's a thumbs up.
Oh, okay.
No. Okay, maybe next.
Okay, next we turn to some issues that have been raised by Australian public sector stakeholders in relation to applying fair value to operational assets, which are issues also addressed by Ipsasby ED 77 in relation to current operational value. Note that the Ipsasby did not develop proposed guidance to these issues in relation to fair value because the Ipsasby proposes that fair value should not be applicable to operational assets. Next slide, please. A practice issue that the AASB was asked to provide guidance on in its fair value measurement project is in relation to applying the cost approach, whether an asset should be assumed to be replaced in the same location, especially if there are potentially cheaper locations in which an asset could provide the same or similar services. There's a widespread view that under the cost approach, an asset's current replacement cost should assume replacement in the most economical manner. Some stakeholders argue that to be consistent with that view, replacement of an asset in a cheaper location should be assumed if that's consistent with the continued delivery of required services. Others have argued that an operational asset's service potential cannot be worth less than the asset's net selling price because that amount could be reinvested upon sale, reinvested in other stores of service potential. Therefore, they argue that replacement of an asset should always be assumed to occur in the same location, because otherwise that unlocked store of service potential could be ignored in the measurement. Yet others have argued for the same treatment of assuming the same location based on the simple proposition that you value the assets you have rather than the ones you might have. And it's quite interesting once you start talking about hypothetical transactions in the world of fair value or current operational value, just where hypothetical notion takes you. Today, we seek your views on this issue by reference to an example in which a public sector entity is measuring the current value of a CBD war memorial, whether at fair value or current operational value, using the cost approach, given that the cost approach is applicable under both of those two measurement bases. And in this case, we assume that the war memorial could be replaced in a cheaper location, that would be feasible in a real world setting. So a simplifying assumption, perhaps. So our question to you is whether you agree with the Ipsasby's proposal that current operational value assumes that the entity will continue to meet its service delivery objectives from the same location in which the existing asset is situated or used. So the answer, yes, is for the existing location, and option B is no, to use the cheaper location for the war memorial.
Okay, we have 55% participant has voted. I'll give 10-15 more seconds. Okay. I think, Patricia, we can close the poll. Thank you.
Most people voted for existing location rather than cheaper location.
Thank you. That's quite a clear preference there from the audience. Participants, if those that have supported existing location or cheaper location would like to provide further comments, keen to hear, especially for personally, if there is someone who have a strong views on that cheaper location and prefers that. It would be great to hear from them. I think Chen, you have your hand up. Thank you.
Thank you. Yes, so I think when the entity makes a decision or the policy or strategy on those service deliverables, the location is probably one of the main objectives. So I argue that you cannot deliver the same objectives if it's different location. For the community, the location is rather one of the criteria. Thank you.
Thank you. Thanks, Chen. Anyone else would like to share the views? David, David, we'll come back to you on if you want to express your views. Great, I see some comments in chat. But let's go to Adam.
Yeah, that is a good point from David too. That there's definitely a community and cultural expectation around these particular sites, and it might not just be war memorial site; it could be any sort of community purpose land. But that as an aside, if you're looking at the equivalent outside of that specific location, that it introduces a quite a large amount of subjectivity, because you can choose at your leisure what particular place you think this site should go to, and it could be it's way too speculative as to where you would put this bit of land in another, in any other place. And the point that Jim made as well, you're valuing what you have as what you see, that particular specific bit of land, not a maybe bit of land in a different location.
Thanks, Adam. David, do you want to elaborate, or that's in line with your comment?
Yeah, it's very similar. So sorry, I had another meeting, so just recently joined, and it's not just the comments Adam made about where would you pick. It would be that the buildings would be different. So what would you be constructing and where? So it's different to having the example I had of the powerhouse and moving that. What would it be? Even the war memorial at the moment, the war memorial in Canberra is going through some controversy or its publicity, in that they've got this $500 million expansion because they're digging underneath. But potentially if you moved it, you wouldn't have to dig underground. You could just build the building on top of wherever it is. So lots and lots of hypotheticals that the organisation itself would not have done in its own planning.
Thanks, David. Thanks, Adam. Okay, so I think we don't have to spend more time on this question, Patricia and Jim, unless you have something to add, given the relative consensus there.
Okay. So
Should I move on to the next slide?
Yes, please, Patricia. So turning now to the broader issue of whether fair value is appropriate for operational assets, and based on the basis of conclusions in the Ipsasby's measurement EDs, the choice between fair value and current operational value seems to hinge on whether the highest and best use concept and maximising use of market participant data concept underpinning fair value are appropriate for operational assets. As mentioned earlier, the Ipsasby considers that holding an asset to meet a service delivery objective, it results in a different capacity than one that satisfies its highest and best use. However, ED 77 does not elaborate on this, and therefore the implications of the proposal to depart from highest and best use concept are difficult to identify. It seems that the Ipsasby's concern about maximising use of market participant data, which AASB 13 calls relevant observable inputs, is based on a similar concern that market participants might price an asset for something other than the asset's service potential to the entity. However, the Ipsasby's reasons are not spelled out, so this is a guess. If market participants for an operational asset held by a not-for-profit public sector entity were assumed to include another public sector entity stepping into the shoes of the entity that holds the operational asset, arguably the service capacity being measured under the cost approach would be entity specific service potential, but however, that service potential would be measured using a market entry price. So perhaps some sort of hybrid thinking that could be coming out of that view. So with that background in mind, turn to question 7, which is whether you agree with the Ipsasby's view that fair value is inappropriate for measuring the current value of operational assets. So yes is that fair value is inappropriate, and no is that fair value is appropriate.
Yes, I think we have 61% of participants voted so far. Leave it open for another 15 seconds or so. Okay, Patricia, I think we can close the poll.
So majority of people still think the fair value is appropriate.
Thank you. And if I'm reflecting on that outcome, it's probably in line with the discussion we had on this with this audience on this outreach, but keen to hear from those participants who are proponents of either view to expand on their opinion one way or another. And again, in the spirit of balancing the debate, if they are proponents of the fair value of inappropriate, if they would like to explore, please feel free to put up your hand. Any takers?
It's David here. Sorry, I haven't worked out how to do the hand thing yet. I think we covered some of the comments about trying to work out who a market participant is and what they would do. I mean, even with the powerhouse example, and it's gone through, as I understand it, I'm not in that state, committees and inquiries or something. For someone else to come along and figure out what they would do, there is no one. So who do you ask for a market participant? And it's like the entity itself has to sort of figure something out because there's no market, so there's no one really to ask for. So that's where some of the difficulty I see. But inappropriate is probably not the right word for me, because we are using fair value. We are using a current value approach.
So thanks, David. So just to confirm, you would be probably more in the camp of tailor fair value to the specific needs, maybe alongside what at least some aspects of the current operational value. Is that fair?
Yeah, I think so. Yeah.
Freddie, maybe we can go to the next question, because the next question is a bit more specific.
Fine with that, unless there is someone else who would like to share while we're on this. If not, yeah, let's go, Patricia, with your suggestion.
Thanks. So this is asking for a richer set of views in the sense that we're putting more options on the table. Specifically, we're noting current operational value. We're inviting whether there are any views on an alternative that we haven't heard from about yet. But also we've got the variation of A, fair value, of the AASB's tentative view in relation to the work that are paused in relation to restricted assets. That where it had got to before stopping to see where the Ipsasby goes with this was to say that it would mandate the cost approach and that would take market and income approaches off the table for these restricted assets that can't be acquired with a restriction or replace with a restriction. And the board was aware that that might not conform with IFRS 13. We've heard comments today from some participants that they would be concerned about restricting the use of the 3 different approaches to fair value. So what the AASB's intention is to do is acknowledge that it's not strictly fair value and that it would be a deemed fair value measurement because it's limited to a cost approach. So that's why option B has been included, and we've got 4 options here, not 3 on the slide. So with all that context in mind, I'll give you time to express your preference.
Okay, I think we are at 58%. Good. 3 more seconds. Okay, I think, Patricia, we can close the poll. We have the usual voting numbers. And if I can summarize, I think unsurprisingly, the majority of participants on this call are in fair value and do not prefer only the cost approach, and a couple of proponents of current operational value with 1 in another current value measurement. So keen to again hear from anyone who wants to explore on any of the preferences, and if there are some other alternatives, or I would call it other tweaks that we could think of in terms of within the remit of fair value or within the current operational value. Please feel free to raise hands and share your views, or just speak up if you. Yeah, Chen. Sorry, Chen, I see your hand up.
Sorry, I forgot to unmute.
All good, thank you.
From my understanding, the current operational value would, I guess, reflect the decision by the entity to limit those assets. So that's why I support C, because I think if we made a strategic decision to limit those assets use to an operational level instead of the best use, then that should be reflected. That's the reason I chose it. Thank you.
Thank you. So yeah, again, I think if to make sure I understand correctly, you would basically are putting emphasis on the entry cost to the entity for its current use.
Yes. Thank you.
Thank you. Anyone else would like to share their views, acknowledging that we have touched on this in various aspects throughout today's session already, and that's why the results are not that surprising, quite on contrary. And I think it shows that there are diverse, at least to some extent, views on the measurement of this type of the assets. I think that might one takeaway from that. Jim, do you want to add anything?
No, I think we've got a rich set of views there already. So if you'd like me to move forward then to the next slide, that's on auditing and assurance considerations that relate to applying current operational value. And question 9, A and B, are really flip sides of the same coin. That first of all, does current operational value, is that foreseen as creating auditing and assurance challenges? And I'm particularly going to ask if there are any challenges not yet mentioned, because we've heard some already around hypothetical assumptions of what would an entity do under current operational value. Also, possibly current operational value would reduce some of the challenges around auditing or other assurance. So we'd like to hear about those. And finally, is there an issue in relation to current operational value that you foresee because it distinguishes current operational assets from other non-financial assets by saying that current operational value applies to operational assets and fair value applies to assets held for their financial capacity, and acknowledging that we do have a similar bifurcation of sorts in Australian standards through AASB 116 in saying whether the recoverable amount test applies to certain types of assets. So all those grouped together for any comments that you may make, particularly comments we haven't heard yet in relation to auditability issues.
So Patricia, do you want to open the poll?
There is no poll for this question.
Sorry. Thank you, of course. So keen to hear about any of those challenges or otherwise. In again, to kick off the debate, would current operational value address some of those challenges that participants have mentioned and Jim has summarized?
Maybe we could change broaden the questions, because I know the questions specifically talking about auditing or assurance challenges. And I note that from in the beginning that we really only have a few auditors participating today. Perhaps you could add on to the cost versus benefit argument. So I guess if I were to rephrase question A, would COV, I guess, add on to any costs in preparing financial statements, and B, therefore, conversely, would adopting COV being entity specific entry value based on existing use reduce any costs in terms of preparing financial statements or preparing valuation for that matter? Marius?
My particular view is that I think introducing another method of valuing an asset will increase both the audit time spent, because we need to understand more about the policies chosen, why certain assets would be. So I would have voted in C in particular in this case, because I think it adds estimates and judgment by management, which needs to be, is always a very high focus area from ASIC and others, and rightly so. So auditing a public asset, where there's a corporate that is valued under a different methodology, will certainly increase an audit from an audit perspective, the time spent to obtain sufficient assurance and evidence to agree to the value. So that's one. The other one is that applying and understanding the reason for the choice between the two will also come with significant challenges, because for financial statements to represent value to the users, the user stakeholders may not have made the same choice in selecting the difference between I kept for economic purpose and I kept for delivering the service outcomes, where I believe the current fair value model does not create that difficulty in distinguishing between the two. So I do believe it will lead to additional challenges. It can be overcome, it definitely can be dealt with, but I believe that in the broad spectrum of public sector, it is going to be a cost increase for the sector.
Thank you. Elise?
Hi there. I think initially there would definitely be some challenges from both all parties involved, auditors, the preparers of the financial statements and the valuers, particularly coming from a valuation perspective. There is certainly, going to be a higher cost implication in adopting a COV, particularly even in relation to C, and being able to properly identify and explain the methodologies and the reasons why some were and some weren't, and having management understand it, the auditors understand it. There's a range of complexity involved, and depending on which consultant you use, there may be differing opinions across that board as well. And I think, generally speaking, the instructions that come from management need to be so clear and so understood around this issue that it guides everyone involved as to what the methodology needs to be, but you're still going to have a bit of confusion running through this. And I know this is probably not relevant in this particular case, but it's something that I wanted to say before. I couldn't work out how to put my hand up, but I have now. And that is, I would have liked to have seen the API, or maybe there is an API representative here, but it's of some concern that moving away from fair value and perhaps the exit price methodology and what that implications that may have on the profession, because as far as I'm aware, the concepts involved in entry price and the COV is not typical valuation principles and modelling, and certainly I'm sure hasn't yet come across the desks of our PI insurers. So it's just another nuance to the complexity, which may or may not have implications on cost, because of many different reasons. But I think the valuation profession definitely has to step up and provide the more comfort, more evidence, more support as to why certain inputs are being used. And I think from an auditing perspective, it would create far more transparency and far more comfort if, as a professional body, we could better that part of the product offering. So they're just some of my comments around the complexity of this, and I think that yes, there will be cost increases as a result. Thank you.
Thank you, Elise. Unfortunately, we don't have API representative here with us today, but they are aware about ITC 45, and they're certainly aware that the board has its own domestic projects. But COV, as mentioned earlier, it's really a proposal from the Ipsasby. And AASB really at this stage is only, I guess, gathering inputs such as yourselves for us to understand whether there's any, I guess, benefit in moving away from fair value. And I think we've received comments. I think majority of comments today is that fair value is still the preferred method, I think, in the earlier question. So we'll definitely reflect that feedback to the board. Are there any other comments on this question? Adam?
Oh yeah, just I suppose a quick point touching back on some of the good points Marius was making, just in that the readers of the financial reports are going to have to make that delineation, and you're then dealing with two different bases of value that the readers need to understand, and that needs to be made very clear to them, and it needs to be like laid out in a very clear format that is easy to understand. But you know, looking from a holistic whole of assets approach, the users then still need to make that delineation and say, okay, well, there's this pool of assets that are done this way, there's this pool of assets that are done this way, and we need to, you know, be able to differentiate and have the users understand the reasoning for the change. It's, you know, it's throwing a I suppose like a fairly different methodology and viewpoint into the financial reports then. So there is going to be that initial hurdle of you know, being able to implement this change and then be able to effectively communicate it and have it understood by the end users as to why the change is being put in and why, yeah, what the difference is now and why it's there.
Thank you.
Thanks. And if I may ask, then are there any, do the participants on at this roundtable, do they see any clear benefits specifically of the current operational value that in isolation, putting aside any transitional challenges and cost or any complexities, if the current operational value would or should coexist with the fair value? But are there any benefits the participants see in the current operational value on its own when compared to, say, fair value, but not necessarily complicated with the relationship? Chen.
I have, I guess, two main issues with best and highest use, and that's why I thought this CLV could help. One issue is that this concept of best and highest use isn't a common understanding of anyone on the street reading our financial statements. If I'm just a normal person without accounting background, I look at financial statements of an entity, they have a kindergarten building. I would assume the value is kindergarten building, not the best or highest use of that building. And that's difficult for us to explain to the communities. Another issue I have is that this makes it us, it's an obstacle for us to link our financial statements to asset planning, because for asset planning, they don't use the concept of best and highest. They are planning on replacing the current asset as it is, whereas best and highest and best use is not really relevant to what we are trying to achieve as providing the service. So that's the two main reasons that I think CLV could help. Thank you.
Yeah,
Thank you.
It's sorry to interrupt. I haven't got this hand thing working yet. I appreciate what Chen is saying, and that really proliferates through the local government sector in particular, because they are constantly seeking to marry financial management planning and asset management planning. And from an asset management point of view, the concept of highest and best use is disregarded because they have a mandate to renew asset and infrastructure assets as they deteriorate. What seems to be an issue, at least from a valuation point of view, is that you may actually be renewing an asset which has little or no value in the fair value context, but it might have in a COV context. And then the question arises, are you actually throwing good money after bad? And so at what point does the literal asset management take over from, I guess, the strategic asset management? And so the fair value question puts in those different parts to the valuation equation, which we assume management would like to know before they commit funds to undertake their asset management. So I think Chen's got a point, but I think the fair value answers those questions more so than the CIB.
Thank you, Martin, and thanks, Chen, for your views. Adam, you have your hand up. Or was it from the previous round? Sorry.
I had my hand up for a different point, but just following on from Chen and Martin, that it is an interesting point, the asset management side of things. I suppose the current operational value seems to, in more instances, be affecting the land asset class than any other class. Often the built assets are done on a cost approach anyway, which does align somewhat to an asset management perspective. Normally for local government assets, we find that applying a market approach to built assets is in the minority. And so being able to provide asset management data on those is not a huge impost to bypass or work around the fair value requirement of a market value or a market approach being used. So that can be overcome. It seems like that it's more so affecting the land value, this COV, and there will be specific asset management processes and policies around, specifically around land management. But I think it's more so, or in our experience, it forms more so, well, the focus is higher on built assets, that's for sure. So yeah, that was my main points on that. Thanks.
Thank you very much, Adam. And this looks like a good point that attracts various opinions. When I'm thinking about it personally, I'm looking at the buildings and I appreciate that depreciable land is not depreciable. But when I'm thinking about land, I'm also thinking about that in many cases, public sector do need to not necessarily replace, but extend the land to provide the services to the growing maybe amount of the constituents within the electorate or area. So even though the land is not depreciated, there might be need to add on additional land for additional public school or additional park, etc. So I think that's where I see the link to the asset planning, asset management also in the land area. Okay, we have a few minutes left. Any further questions or comments on this question or questions that would like participants would like to share? All right, Jim, Patricia, where does this put us?
I think that we probably shouldn't open up any more issues. So, Freddie, I suggest back to you for closing comments and next steps, please.
Thank you. So, yeah, first of all, thank you very much for all of you that dialed in and attended this virtual roundtable. As I mentioned, it will form a valuable input into the further board deliberations and discussions on the Ipsasby proposals to form their view how to respond to those. And the board will continue to discuss these proposals at its August and September meetings. On this slide, we put a few links and also the link to our page where you can submit your submissions directly to AASB. And we would encourage submissions to both to us and also Ipsasby. Also, the board will, or we are planning for the boards to continue consideration of the feedback on the invitation to comment 45 for the AASB fair value measurement project at the moment from November meeting this year onwards. I think the aim of the session was to first educate and provide overview of the proposals, and gather and second also gather the feedback. So I think that that hopefully fits the bill and achieve the purpose. But before I going further, Alice, do you want to mention anything? You have your hand up.
Yes. So I just wanted to highlight, I know that you have your own deadlines and timeframes, just to probably mention that when I've spoken to some of my clients on this matter, they are very, very busy with financial statements and audits themselves. So the 3rd of August has proven to be a fairly difficult time frame for them at this stage. For anyone looking to prepare feedback, if you aren't receiving the quantum that you were hoping, that's probably the reason why. So I just wanted to flag that.
Thank you for that, and we appreciate that the timelines may not necessarily work, especially in with Australian financial year. So yeah, if we can get any thoughts in any shape or way or form as they are being maybe drafted or finalized from those constituents that are going to submission, keen to consider those as early as possible, because obviously we do want to finalize AASB board submission before the Ipsasby deadline.
And I just want to add that in the very last slide that will show that we'll include contact details of myself, Freddie, and Jim. And so if there are any, I guess, informal feedback they want to provide, you can email directly to us. That's why if you don't have time to write a submission.
Absolutely. So I think that takes us to the next slide, where we highlighted, I think, number of ways how you can interact with us, and we're always using opportunity to spruik those resources, and hopefully they are of useful to the constituents. And also I will mention this opportunity that AASB website has been refreshed and upgraded recently, so hopefully it's more user friendly if you are engaging with the website. So with that, let's move on to I think what is the next slide, which is really, first of all, thank you. We do appreciate that you take 2 hours out of your busy lives to provide input into the AASB processes. So thank you very much. As Patricia mentioned, here are our contact details. Please do call us, send us an email, and keen to hear feedback on this project and any other or anything else you want to discuss with us and or ask. So I think with that, unless Patricia or Jim will tell me that I forgot something important, again, I would like to say thank you again, and have a good day.
Thank you, everyone.
Thank you.
Thank you.
Thank you.